Good morning, everyone. My name is Joshua Bauchner. I'm a partner at the law firm of Mandelbaum Barrett, where I work in the litigation practice group as well as chair the cannabis, hemp, and psychedelic practice groups. I'm very excited to be here today with my colleagues Marty Hauptman and Darren Gleeman. We're going to be discussing ESOPs and how they can help cannabis companies in particular circumvent 280E. But before we begin, Marty, do you want to give please a quick introduction?
Yeah, I'm an attorney and a CPA. I've been practicing in the ERISA area since 1974. I've drafted, designed, and qualified ESOPs, terminated ESOPs, handled audits of ESOPs at the IRS and Department of Labor levels.
Excellent, thank you. And Darren, a little introduction, please.
Yeah, so my name is Darren Gleeman. I'm with MBO Ventures. I come from a different perspective. I ran a hedge fund from 2001 to 2018, where we figured out the stock market. We found ways to make money in the stock market, and we traded 1% of the stock market every single day, which are billions and billions of shares. We came up with a lot of patterns. I entered this space back 2019. And I've been in the ESOP cannabis space, I guess, since 2021, when I uncovered the structure that allows us to make 280E irrelevant. And to date, we've structured every single cannabis ESOP in the nation that's closed.
That's terrific. All right, gentlemen. So let's get into it. Darren, I'm going to start with you very basically. What is an ESOP?
Yeah. So to me, right, the way I think about it, and we earlier had this discussion, myself and Marty, he comes at it from a different perspective, which is fantastic, and I love it. To me, an ESOP is just another way to sell your company, right? You can sell your company to a private equity firm. You can sell your firm to a strategic buyer, or you can sell your firm to your employees via this thing called an ESOP, And so this thing called an ESOP, why sell your firm to your employees, right? They have no money. How can they do it? Well, the government wants you to sell to the employees, right? They really want to democratize capitalism. So they came up with a way for the employees to acquire it. And they came up with a way to incentivize business owners, okay? And what they did is they stuck it into a bill way back in the day in the 1970s. So how do they incentivize you? Well, on a very big overview, they incentivize you with taxes. Number one, when you sell to an ESOP, you can defer your capital gains. Structured correctly, you can do it forever. Number two, and this is the biggest thing that we have here, is when you sell 100% of your company to an ESOP, right? The company runs completely tax-free, zero federal income tax and zero state income tax. And number three, you can also get a second bite at the apple with these things called warrants. And there's a bunch of other tax things, but that's the biggest ones right here.
Now, Marty, I can see you've got something to add here. What do you want to say for that definition of ESOPs?
Darren, what you're saying is great, but you're crossing two different concepts. In an S Corp, you can avoid all federal and state taxes. In a C Corp, you can get the deferral of the gain on the sale of the assets. You don't get it on both sides of the coin.
Correct. And so what we do, Marty, really good idea, right? What we do is that's called restructuring. So every single deal that we do, I don't care if you're a C Corp right now or an LLC taxed as a partnership or taxed as a C. It doesn't matter. You're going to have restructuring, just like if you were bought by private equity or strategic buyer. So yes, what we need to do is do some restructuring. But when you do the ESOP, we are going to get you those two things. We're going to be able to allow you to defer your capital gains tax. And we're also going to then make you completely income tax free by doing the restructuring. But good points.
So then how does this touch what is the third rail of all cannabis, right, Darren? 280E, right? Which basically means cannabis companies are being taxed on their gross profits. They can't take those standard business deductions. So if you can first explain a little bit about how 280E works and then why this helps.
Yeah, so 280E, this allows all expenses, okay? You cannot deduct your salaries, as we all know. You cannot deduct your rent. There's no deductions at all. So you're getting taxed on your gross profit. Imagine running a law firm. Imagine running your firm right now and not being able to deduct your or Marty's salaries. That's ridiculous. And the building that you guys are in, you can't deduct that rent. It's crazy. So the effective tax rate for cannabis firms, they could be anywhere from 50 to 70%. There's actually firms that are higher. So it chokes you. It chokes you. Well, when you structure properly inside an ESOP, there are no income taxes. It completely 100% goes away. Zero federal income tax and zero state income tax. And when that occurs, 280E becomes completely irrelevant. Now, as Marty suggested before and he explained, the only way for this to work is if it's structured inside of an S corporation. And that's okay. We're going to easily structure you inside of the S corporation. An S corporation is a flow through, right? What that means is it's not taxed at any entity on top. It goes right through to the shareholders. Okay, so with an ESOP, there's only one shareholder now. It's called the Employee Stock Ownership Trust, an ESOT, Employee Stock Ownership Trust. The employees are beneficiaries of this trust. Okay, so now what happens is the company, right? We fill out a tax return, whatever that tax return, you fill out the 1120S, that's the tax return. And you take no deductions. We're not evading 280E. We're not getting around 280E. We're not skirting 280E. You're following 280E to the T, and you're way above the line. So there's going to be a big, huge profit now. So the next step after there's a big profit when you fill out your tax return as an S Corp is you send K1s to all the shareholders. There's only one shareholder here, which is this Employee Stock Ownership Trust. So the ESOT gets it. They get the K1, and then we look at it, and we check it off, filed away, no tax and no distribution. Hence, 280E becomes completely irrelevant.
So it basically takes all of that profit and it says this profit is no longer taxable income because of the ESOP. Is that simplifying it accurately?
Yeah, that's pretty much it. It's your EBITDA, which is your earnings, right? Your real earnings. That's your cash flow now. No taxes. I mean, it's crazy. It's the most crazy thing, but you now have a company that pays no income taxes. And this is done in many industries. It's just for the cannabis industry, it's pretty crazy.
And you said it has to be an S Corp. Now, many cannabis companies form as LLCs for different reasons. It will not work in an LLC structure. Is that correct?
Right.
No.
So, Marty, go ahead.
I mean, basically that structure, it has to be an S Corp. And the ESOP becomes the sole shareholder in the S Corp. So all of the profit flows through to the ESOP, and that's allocated among the employees who are participants in the ESOP.
So then briefly, gentlemen, because like I said, a lot of cannabis companies are LLCs. Can they transition from an LLC to an S Corp for this purpose?
Yeah, many states have conversion statutes where you can convert from an LLC to a corporation, and then you make the S election under a Form 2553. New York, New Jersey have the automatic conversion statutes. Delaware does. Most other states do.
So it's super easy. If you're an LLC, tax as a partnership, tax as a C, it's almost like a check the box to become a C corporation and then into an S corporation.
You're an S Corp. You're now going to do the ESOP, which by the way stands, I don't think we've done this yet, but
Ownership plan.
Ownership plan.
Thank you. That's why I have you here. And so now you're taking it so that there's no taxable income. 280E becomes irrelevant because you don't have to worry. You also mentioned, Darren, that there are other tax deferral options. How does that work?
Well, a great tax deferral option is when you sell the company, right? Let's just take an example. Let's say the company, let's just make it big numbers, make it nice. Let's say the company has 20 million in EBITDA. It's a nice juicy firm, 20 million in EBITDA, and the value is 20 times 5, a multiple of 5, $100 million. Value is $100 million. Normally, if you sell a $100 million company, right, throughout the country, you got to pay capital gains tax. Depending on the state, it's a little bit different, but overall, it's about 30% is what the cost is. So you sell a company for $100 million, you got to pay 30 million in capital gains tax. With an ESOP, that's another one of those special things. If you sell to an ESOP, the government allows you to defer those capital gains. And if you structure correctly, you can defer it forever. Now, I'm not sure. Do you know what a 1031 is, Josh, in the real estate world? A 1031 is a like-kind exchange. Oh, Marty, do you want to go through that?
All right. Basically, in an ESOP, if you're a C Corp, and you sell a minimum of 30% of the stock to the ESOP, you can avail yourself of Section 1042 of the code, which allows you to buy replacement securities within a 15-month period. The replacement securities basically consist of stocks or bonds or basically any other investment other than mutual funds. And the game plan typically is you hold those replacement securities until you die, and then you get a total step up in basis and avoid all of the tax. If you sell parts of those replacement securities, you will end up paying tax on that piece that you sell, which can be spread out over a number of years to minimize the overall tax consequences.
So that's pretty extraordinary. So I think a lot of folks are familiar with a 1031 exchange for real property. You sell a piece of property, you don't want to pay the tax on it, so you buy a similar piece of property, like kind exchange, and you basically just tag the taxes onto that property, and you can go on and on. Under 1042 of the code, it's a similar tax deferral process, except here you're buying some sort of securities to make like kind for the shares in the company that you're selling to the employees, as opposed to real estate. Is that accurate?
That's basically correct. I mean, I'll give you an example. We did an ESOP a couple of years ago where the client bought floating rate notes, and the interest rate on the note is pegged to prime plus a number. And she's holding those notes, and the game plan is she lives off the income on these notes and will hold them until she passes, getting a total step up in basis at death, avoiding the income tax on a couple of $1 million.
Yeah. So the code, right, is the idea here again, that back to that $100 million example. You need to now, right, reinvest $100 million in another U.S. operating company, right? So another U.S. operating company can be the S&P 500, right? That's where your stocks. It can be bonds like that floating rate note. It can also be real estate, right? And you structure it correctly. As long as you hold on to that, you never pay capital gains tax. You then die, and then your kids get what Marty's saying called the step up in basis, and they're good to go. Pretty awesome.
I mean, it does sound pretty awesome. So in addition to deferring that tax, you're then also investing all of that money in, like you said, a US-based security, and these days earning 10, 12% of a return, all tax-free.
Yeah. Well, the
income is taxable, but you don't pay the capital gain tax until you dispose of the security. So if you bought a bond that pays you 6% and you got $60,000 of income, that $60,000 is taxable.
Right.
But normally what happens is you can't afford the bond. So again, you sell the company for $100 million. How are you going to buy a $100 million bond? You don't have the cash. So what you got to do is you got to borrow that. So there's a way to borrow it. That's no problem. So you can borrow the $100 million from a bank, and they'll lend it to you, right? But they're going to lend it to you such that you have what's called negative carry. So if you do those floating rate notes, you're not actually getting that income unless you pay all cash, which nobody can in the larger deals. And since you can't pay all cash, you have to borrow the $100 million, right? So you're borrowing $100 million, and you're getting that income of, let's say, 6%. But if you're getting income of 6%, you might be paying out 6.25%. So you always have that little negative piece. Plus, with the floating rate notes, you're personally on the line for that. You're on the hook. Which those companies can never go under, right? These are solid companies like Gleeman Brothers and Bear Stearns, right? I'm being facetious. And AIG. Back in the day in 2008, 2009, everybody did this with floating rate notes with AIG. And then what happened is AIG almost went out of business, or they were out of business. But Congress allowed them to stay. If they had gone out, everybody would have lost a lot. And that's where we then came up with an idea of how we can go about doing this with real estate.
So we have a question here. It says, so the revenue goes on a K1, which is distributed to the employees that opted in. That income gets transferred to the personal tax return. I think the predicate for this question might not be right. I know.
Right.
Let's just say they take ordinary business expenses to reduce the tax liability. But I think the critical part of this question is what happens when the IRS finds out the income is from cannabis? So I'm going to answer the last part, and then Darren, I'm going to come back to you to explain why the first part is inaccurate. There's actually some tax court opinions on this. I'm sure you're both familiar, where the IRS wants its vig, right? I mean, they got Capone for not paying taxes. Cannabis companies, even though technically federally illegal, the IRS still does collect its taxes on the sale of cannabis. That's why we're frankly having this conversation today, right? It's those profits from those sales that we're trying to create a tax avoidance scheme. And I mean that in the lawful way. I don't mean scheme in a derogatory way. But Darren, if you want to just correct about the revenue going on the K1 and the personal tax return, that's not actually how this ESOP works, correct?
Yeah. So the K1 is not the revenue. It's your you're filling out you're filling out the actual income tax return, right? So you're filling out your tax return. And so that's the actual company. That's the profit of the company, right? So the profit of the company is, let's just say it's $20 million. That's the profit of the company. Now, because it's an S Corp, what happens with the $20 million? All All right, well, it gets distributed out, you say via the K1, not the cash. We're not talking about the cash, right? This is just how the actual income tax is allocated. Now, there's one shareholder here. The employees are beneficiaries of this trust. So they're not getting anything of this. The trust itself gets this K1, and they're the one that's tax exempt. It never goes to the employees, that actual cash. Again, this is to the trust. Did I explain that right, Marty?
Well, yeah, that's right. But the next step is that each employee who's participating in the ESOP has an account with a fractional interest of that theoretical profit. So that when that employee retires or leaves, he or she is going to get a portion of that account paid out to him or her.
That's the next question, is how do the employees get this account, right? And how did they get there?
That was the question, right? And before we get there, do the employees have to pay for this? I mean, you're selling the company, right? We've been discussing this. You're selling the company to the employees. Are the employees stroking a check to pay for their?
Well, basically, the way it would happen is the profit of the company goes to the ESOP trust. The ESOP trust is then paying the note to the owner who sells the business. So if Darren is selling the business for his $100 million and you've got a $20 million profit this year, we take the $20 million each year and pay it to Darren. So in 5 years, he's paid out.
Right. I mean, it's just like a private equity deal. It's almost identical, right? So in a private equity deal, same thing. Let's just say it's a $100 million private equity deal. People think, ooh, they're giving me $100 million from their fund. No, that's not how it works. It's just like an ESOP, except there is equity. With a private equity deal, right? And I'm private equity. What I do is from my own fund, I'm going to give you $20 million. All right. That's my risk. I give you the 20 million. Then what's called a leveraged buyout. I'm now leveraging your company. So if your company is making $20 million a year, I'm going to go to like JP Morgan and borrow 60 million. When I say I offer the company's cash flow, the company's taking that risk. So we borrow $60 million. And that goes to the owner also. So again, 20 million from the private equity firm goes to the owner. The 60 million that we borrow goes to the private equity, goes to the owner. That's 80 million. Okay. And the other 20 million is called an earnout. That means as long as the company reaches the level they told me they were going to reach, they get paid the last 20 million. They don't get it. They don't get there. They don't get paid the last 20 million. Now the ESOP, as Marty explains, is almost identical to that, except there is no $20 million equity. It's all debt. But they can go out to the same lender and they can borrow that same $60 million that the private equity firm is going to do. And then that $60 million goes to the owner. And the rates and the terms are going to be a little bit better there. Okay. And then the other 40 million, remember, there's $100 million. The other $40 million is a seller note, which is an IOU from the company back to the owner. And that's how they get the $100 million. Cost the employees absolutely nothing. This is just a huge benefit for the employees.
All right. So, I mean, this is starting to sound too good to be true, gentlemen, right? The owner of the company makes all this money. Everything's tax deferred. You're not paying income taxes. You're not subject to 280E. Employees get ownership in the company. They don't have to pay for anything. Where's the downside? Where's the risk?
You know, it is funny. This is like one of these government programs that actually works because it really does, right? I mean, the incentive here, again, back to what we said at the very beginning, is how do we get equity ownership into the hands of the employees? And it works. Now, if every single company in the United States did this, well, we would bankrupt the United States. But there's such a small fraction of people that actually do this. I don't know why. It's just super, super complicated, and you need to be able to dilute it down. So most companies don't even know that this exists. But yes, it's a huge government subsidy, and it works to get employee ownership, broad employee ownership.
I mean, basically, it works because when your S Corp now sells out to the next level of VCs, what's going to happen is that profit is going to go into the ESOP trust and it's going to be spread out among the employees. So those employees are now going to share in that next round of sale. And they will, in fact, have in their retirement accounts X dollars. And basically, that can be rolled over to an IRA and they can take their required minimum distributions. Or if they're under 59 and a half, take the money with the penalties. And there's another way to get money out of the IRA accounts is under 72T, you can take basically a lifetime annuity commencing at any point. So, I mean, the employees can benefit significantly with the ability on the sale of the ESOP.
All right. Well, so far so good. So I'm gonna challenge this a little bit more. What if the company gets bought? We discussed before we got on today, multi-state operators buying the smaller operators. You know, one of the larger, even publicly traded, they buy the company. How does that work?
Awesome. That's the best thing for everybody. You know, a lot of people think, wait a second, if it's ESOP owned, can I do? What's the future? It doesn't matter. Like if you're an ESOP owned company, it's the same thing as a private equity owned company. The same thing if Darren owns the company or Josh owns the company. It's just a different shareholder. You can sell the company, you can go public and do all those things. So what would happen normally? And let's just say in that case, we use the $100 million example. And now let's just say we get bought, Budweiser comes in 10 years down the road, federal legalization occurs, and let's just go high. They come in and say, you know what, we want to buy you for $1 billion. Okay, $1 billion. Why not? So what happens here is this. The ESOP, the actual ESOP itself will get terminated. All of the employees will vest automatically. There may have been warrants in the deal. Most likely there were. So let's say the owners, let's just use a random number. They had warrants for, let's say 15% of the company. Okay. And the strike price, the predetermined price to buy back 15% was very low. Let's say it was $1 million. Okay. So what they do now is, again, the ESOP gets terminated. Okay. They hand in their warrants. They write the check for $1 million, the warrant holders, and they get back 15% of the company. The $1 billion comes in. 150 million goes to those former owners that had the warrants, and the other $850 million gets distributed among the accounts for all the employees. It's pretty nice. It's pretty nice.
All right. So then I'm going to one step further. All right. The company doesn't get bought out by an MSO. It goes in the other direction. Financial distress, can't file for bankruptcy because of the federal prohibition. Maybe it files for, benefit creditors. What happens if the company goes under?
Exactly like any other company if it goes under. Now, if it's going under, right, that means that all those employees, just like any other owner, their value, their equity is going to be worth nothing. Right? They're going to be worth nothing. It's not going to get anything because there wasn't anything in their accounts. So
but they're also not losing anything, right?
No, they lose nothing. No, and they also have their own IRAs that they could have been using and doing whatever they want with. That's totally fine. Just because you have an ESOP doesn't mean you can't have an IRA also.
All right. So now, these are questions coming in, and I appreciate them. High turnover. The employee leaves. Is there a vesting period? What happens if they're there for 5 years and then leave? Do they take their ownership with them? How does that work?
Yes,
they don't take the ownership shares. They take dollars. Basically, when we structure the ESOPs, we put a provision in the corporate bylaws which prohibit an employee from taking shares. So basically, the company is going to, each year, when you have an ESOP, you have to do an independent valuation. And basically, based on that independent valuation, the shares held by the ESOP will be valued. And basically, if Josh has 4 shares of ESOP stock allocated to him, and it's $100 a share, he's going to get a check for $400.
All right.
So
well, that's not so bad.
Yeah, so I see Paula has some questions about the employees. Very quickly, Paul, this is how it works, right? So how does someone get shares? There's 2 buckets here. There's something called a vesting bucket, and then there's a stock allocation bucket. So vesting means what percentage of that stock can I get? And that's trying to keep you there for a while. So usually vesting is, let's say, over a 5-year period. So you're there for 364 days and you quit, you get nothing. You're there for 365 days, you get a vesting of 20%. You're there for 2 years, 40%, 60, 80, 100%. That's the vesting. In terms of stock is allocated over a very long period of time for the employees. Usually, let's just say it's about a 25-year period. So if it's a 25-year period, by definition, that means you're going to get allocated 4% of stock is going to be allocated every single year. So if someone is there for 4 years, right, they will have allocated 4 times 4, 16% allocation. They will have received whatever percentage they get. And then they're vested over 4 years, let's say it's 80%. So if they leave, right, if they do the calculation. But what happens, Paula, is when people start seeing their account and they start seeing the value, they're not going to leave. And so what happens with an ESOP-owned company is that retention increases by 300% more than a non-ESOP-owned company, which is a crazy statistic, right? It's a crazy statistic. So you don't want to leave.
Wow. All right. So I keep trying to challenge you on finding something here that won't work, some negative. We haven't found it yet. Is there a minimum company size, either by number of employees or dollar value, that's required to do this?
Yeah, so I would say the smallest company should be about 20 employees. That's really the floor number of employees. And in terms of your size, the size about minimum EBITDA is about $2 million in EBITDA. Would you agree, Marty?
Probably, just because of the setup costs involved.
Yeah, it's very expensive. And no, you're not Debbie Downer, Paul. It's just I can't really see the questions. They need the great questions.
Well, and so we do need to wrap this up because we promised people 30 minutes, just a little bit of a tease here to get them back, because I hope we're going to do this again, gentlemen. There are these administrative costs, explaining it to the employees, fiduciary obligations, right, to the employees to ensure they know what they're getting into. What does it cost to actually engage in this type of transaction in ESOP?
It's super expensive. You're talking anywhere the minimum all-in fees, because you're talking you have an attorney, you guys, right? You're representing, let's say, the owner. Then you have a trustee. Then you have an attorney that's representing the trustee. Then you have an investment banking firm. Then there's a valuation firm that the trustee is using. So all in, fees could be anywhere from all in 700,000 and upward.
Okay.
Ka-ching.
And ka-chings. All right. But that's one time, and then you get all of these benefits. So it's a significant.
Oh, it's de minimis. And like, for instance, for our fees, a lot of times what we'll do is we'll take time haircuts. So you can pay a certain fee at the beginning, and then over time you pay some money out. This way, because a lot of these firms have been choked for such a long time because of 280E, where all of a sudden it's like Shangri-La having all that cash flow. So sometimes we wait to get paid out because now they have cash flow to actually pay out.
So that makes some good sense, right? There is this initial upfront cost, which is not insignificant, like you said, but when you consider the tax savings long term, the retention from the employees, the savings not having to train employees, the attrition and the rest, I mean, you're going to make that multiple times over the course of this exercise.
Yeah, it totally makes sense. And I just want to stop, like, guys, you heard like Marty. Marty has forgotten, by the way. Marty has forgotten more than I will ever know, right? I mean, he knows everything, right? I mean, I'm the sales guy, I understand it and I can explain it, but Marty, he's like, he gets it.
It takes a village. Gentlemen, Marty, Darren, thank you so much for your time today. I appreciate everyone who joined online. This is going to be the first of more to come. We certainly hope. It was kind of to wet everyone's beak, to introduce them as enthusiastic as we are to ESOPs, because we're very sensitive to what cannabis operators are going through with these tax consequences, trying to be profitable. A lot of headwinds, a lot of compliance, regulatory costs. So this is a great way to get value out of the company, give it to the employees, not be subject to 280E, defer taxes. I mean, as you heard this morning, it checks a lot of boxes. Any final thoughts, Marty?
No, I mean, they're basically, it can be done, but you need the right situation. It's not for very small companies. You've got to be able to absorb a lot of the upfront costs, and the long-term gains are phenomenal.
Darren, final thoughts?
Yeah, I disagree with what Marty just said. To me, it's a no-brainer. This is a game changer. And what you'll notice in our cannabis space, a lot of people are going to be doing this, including the public companies. It's a game changer in the industry.
Terrific. All right. Well, thank you again, gentlemen. Thanks for everyone who joined in today. For additional information, Darren, why don't you give your website so people can contact you?
Oh, yeah. So it's Darren Gleeman on top, and I'm at mboventures.com. Just figure it out. Darren Gleeman, MBO Ventures or Cannabis. It'll pop up somewhere. And you can get me on LinkedIn also.
Yeah. And for anyone who saw the invitation, it's got all of our contact information. Marty and I are with Mandelbaum Barrett, of course. Thanks, everyone. And we'll talk to you soon.
Thank you.